Can I tell you something that took me way too long to figure out? Investing is not complicated. I know what you're thinking. You've heard that before. And then somebody opens their mouth and starts talking about index funds and expense ratios and asset allocation, and your eyes glaze over and you close the tab. I did that too, for years. Because nobody in my family invested. Nobody sat me down and walked me through it. So every time I tried to learn on my own, it felt like I was trying to read a textbook in a language I didn't speak. Here's what I eventually figured out though. It was never complicated. It was just explained wrong by people who either wanted to seem smart or who wanted you to feel like you needed them to do it for you. You don't. This video is the walkthrough I wish I had when I was 25. No assumptions. No. Well, obviously you know what a brokerage is. We're starting from zero. By the end of this, you'll know exactly what to open, exactly what to buy, and exactly how to set it up so it runs itself. Let's go. Okay, before anything else, I need to take something off the table. The idea that investing is only for people who already have money. I believed that for a long time. I thought investing was something rich people did with their extra money after everything else was taken care of. Like it was a luxury. Like it was the step that came after you had it figured out. It's actually the opposite. Investing is how regular people like us, build real wealth over time. Not by earning more, not by being lucky. Just by starting, being consistent, and letting time do the work. Here's the thing about the stock market that changed everything for me when I understood it. Over the last 100 years, through world wars, recessions, crashes, pandemics, the U.S. stock market has averaged about 7 to 10% growth per year. Your money, doing nothing except sitting in a broad market fund, has historically doubled roughly every 7 to 10 years. Your savings account, paying you maybe 0.5% to 5%, and inflation eats most of that. I'm not telling you the stock market is a sure thing. Nothing is. But I am telling you that doing nothing, leaving your money in a checking account and hoping for the best, that has a guaranteed outcome too. And it's not a good one. Let's talk about how to actually start. All right, here's where people get confused first. And it's actually the simplest thing once somebody explains it. When you invest, your money lives inside an account. Think of the account like a container. The investments, what's actually growing your money, are separate from the container. Most people think investing and opening a brokerage account are the same thing. They're not. The account is just where the money lives. What you do with the money inside, that's investing. There are 3 accounts you need to know. That's it. 3. A 401k is a retirement account your employer offers you. You put money in before taxes come out, which means you pay less tax today. The government lets you delay that. The money grows in there tax-free until you retire. Then you pay taxes when you take it out. Now here's the critical part, and I already talked about this last week, but I'm saying it again because it's that important. If your employer matches what you put in, you take every single dollar of that match. That's a guaranteed return on your investment before you've even invested in anything. Nothing beats it. Nothing. Figure out your employer's match. Contribute enough to get all of it. That's your first move. Now this is the one I wish somebody had told me about when I got my first real job. A Roth IRA is a retirement account you open yourself, not through your employer. You go open it, you fund it, it's yours. Here's what makes it special. You put money in after taxes, but everything it earns, all the growth, all the compounding, all the returns over decades, comes out completely tax-free when you retire. Tax-free? Think about what that means. You put in $6,000 this year. Over 30 years, it grows to $45,000. You pay zero tax on that $39,000 of growth. Nothing. Because you already paid tax on the original $6,000 going in. Wealthy families open these for their kids as early as possible, because decades of tax-free compounding is one of the most powerful wealth-building tools that exists. Most people in our situation have never even heard of it. If you don't have one, opening a Roth IRA is one of the best financial moves you can make this year. We'll get to how in a minute. Third account, the regular brokerage account. This is just a standard investment account. No retirement rules, no age restrictions, no penalties for taking your money out. You put in what you want, take out what you want, whenever you want. The trade-off? No special tax breaks. You'll pay tax on your profits when you sell. This is the account you open after you've got the first two handled. It gives you flexibility, and flexibility has real value. Follow that order, and you're doing it exactly right. Don't skip ahead. Don't open a brokerage account first because it feels simpler. Get the free money and the tax advantage before anything else. Okay, accounts explained. Now, what do you actually put inside them? This is the part where most people fall into a rabbit hole and never come back out. They start researching stocks, individual companies, crypto, options, things they saw on social media, and 6 months later, they've learned a lot, done nothing, and their money is still sitting in their checking account, earning nothing. So I'm going to give you the straight answer. Index funds. That's it. That's the answer for most people who are just starting out. And honestly, for most people, period. An index fund is a fund that owns a tiny piece of hundreds or even thousands of companies all at once. The most common one tracks the S&P 500, the 500 largest companies in America. Apple, Microsoft, Amazon, Google, Johnson & Johnson, all of them in one fund. When you buy a share of an S&P 500 index fund, you own a little sliver of all 500 of those companies. If the American economy grows over time, your investment grows. You don't have to pick winners. You're betting on the whole thing. And because nobody is actively managing the fund, picking stocks, making trades, the fees are tiny. We're talking fractions of a percent. More of your money compounds instead of going to someone on Wall Street. Warren Buffett, one of the greatest investors alive, has said publicly that most people would be better off just buying a simple index fund and never touching it. When Warren Buffett says keep it simple, I keep it simple. Now let me give you the exact setup. You could honestly build a solid investment portfolio with just 3 funds. That's it. Fund 1, a U.S. Total Market or S&P 500 index fund. This is your core. It owns the broad U.S. stock market. Everything else builds around it. If you're at Fidelity, look up FSKAX. If you're at Vanguard, VTSAX. If you're at Schwab, SWTSX. Fund 2, an international index fund. This owns companies outside the U.S., Europe, Asia, emerging markets. It diversifies you beyond America because the U.S. isn't the only economy growing. Fidelity, FTIHX, Vanguard, VXUS. Fund 3, a bond index fund. Bonds are lower risk, lower return. They stabilize your portfolio when stocks drop, and stocks will drop sometimes. The older you get, the more bonds you want. When you're young, you need less. Fidelity, FXNAX. Vanguard, BND. That's the 3-fund portfolio. Boring name. Proven results. Millions of regular people have built real wealth with exactly this. No stock picking, no watching charts, no trying to time crashes. Set it up. Contribute consistently. Leave it alone. Let time do the rest. All right, now the part most videos skip. How do you actually do this? Step by step. Let's go. Step 1. Pick a brokerage. The 3 most beginner-friendly are Fidelity, Vanguard, and Charles Schwab. All free to open. No account minimums to get started. All offer excellent index funds with tiny fees. My recommendation, if you're starting fresh, Fidelity. The app is clean, the funds are excellent, and if you ever need help, their customer service is solid. You can open an account on your phone in about 10 minutes. Step 2. Open a Roth IRA. Go to fidelity.com, click Open an Account, select Roth IRA. You'll need your social security number, your address, and your bank account info to fund it. It takes about 10 minutes if you have everything ready. One thing to know, in 2026, you can contribute up to $7,000 per year if you're under 50, as long as you have earned income and you're under the income limit. Step 3, fund it. Link your bank account. Transfer money in. Start with whatever you have. $50, $100. The amount is less important right now than the habit.
Here's the thing, people get the money sitting in. Your Roth IRA isn't automatically invested. It just sits there as cash until you tell it what to do.
Step 4, buy the fund. Once the money lands, search for the fund you want. If you're at Fidelity, type in FSKAX, buy it. All of it. Don't let that cash just sit. Step 5, and this is the most important step. Set up automatic contributions. Go into your settings. Set a recurring transfer, weekly, bi-weekly, monthly, whatever fits your paycheck schedule. Pick an amount, even $50, and set it to happen automatically. From that point, it's on autopilot. Money comes in, it gets invested, it compounds. You stop thinking about it. This is called dollar cost averaging, and it removes emotion from the equation. 5 steps, that's it. You're an investor. Before I let you go, I want to talk about the 3 things that stop people from doing exactly what I just described. Because the steps aren't the hard part. Something else is, and I want to name it. The first one, I don't have enough money yet. I hear this constantly. And I get it. It feels irresponsible to invest when money is tight. But here's the truth. You don't need a lot to start. Most brokerages have 0 minimums now, $25, $50. The habit of investing, the muscle memory of it, is worth more than the amount right now. Waiting until you have enough usually means waiting forever. Because for most of us, enough never fully arrives. The second one, I need to understand it better before I start. I understand this one too. You want to be sure. You don't want to make a mistake. But here's what that thinking costs you. Time. And time, as we talked about, is the ingredient you cannot buy back. You learn investing by doing it, by watching a fund go up and down, by feeling the anxiety of a market dip and learning that it comes back. You will never feel fully ready. So start before you're ready and learn on the way. The third one, and this one breaks my heart a little. I'm already behind. What's the point? I've heard this from people in their 30s, their 40s, people who look at where they are and feel like the window closed while they weren't looking. It didn't close. Starting at 35 with nothing is not the same as starting at 25. I won't pretend it is, but it is dramatically better than starting at 45 or 55 or never. There's a saying I think about a lot. The best time to plant a tree was 20 years ago. The second best time is today. You can't go back, but you can start today. And today will be 10 years ago before you know it. So here's where you are right now. You know what investing actually is. You know the 3 accounts and the order to open them. You know what to buy. You know the 5 steps to get it done. And you know the 3 things that'll try to talk you out of it, so you can recognize them when they show up. That's more than I knew for years, more than a lot of people know right now. The only thing left is to do it. Open that Roth IRA this week. Not next month, this week. 10 minutes. Your future self will thank you in ways that are hard to even calculate right now. Drop your questions in the comments. I read everyone. And if you want me to go deeper on any part of this, the 3-fund portfolio, Roth income limits, how to pick funds inside your 401k, let me know. That video's already on the way. That's what we do here. I'm Uncle Tim, the conversation your family should have had. I'll see you next week.